India's trade data was published on Thursday. Merchandise trade exports rose to a record high for the full fiscal year FY23, as did services exports. But is that a feat that India can repeat in FY24? To share her views, we're joined by Rajani Sinha, Chief Economist at CareEdge. Ma'am, thank you so much for taking time out for us today.
Thank you, Pallavi, for this opportunity.
So I'll dive straight into it. We saw exports as well as imports, merchandise, see a sequential improvement for March. And for the full year, we saw record high figures for merchandise exports as well as services exports. However, in the last few months, there has been a little bit of slowdown in merchandise exports led by the global slowdown and the headwinds from there. What's the outlook that you're looking at for FY24?
So for FY24, we are not very optimistic on exports front because even if you look at the performance of exports in FY23, the jump in exports that we have seen of around 6% in merchandise exports, that's mainly because of high petroleum product exports. So it's high commodity prices which had a big role to play in our exports. And even FY23 data, if you remove the petroleum product exports and you look at the exports eliminating that, exports have hardly recorded a growth. It's like they have remained stagnant. And if I look just at the last 6 months, there has been a contraction in exports growth that has been happening. So the global slowdown that we are seeing all across is having an impact on our exports. And we feel that more so we are going to feel it in FY24. So we have actually factored in our merchandise exports contracting by around 4 to 5% in FY24. But we remain bullish on our service sector exports. Service sector exports post the pandemic has seen very significant improvement if you see the data. And we expect that even with the slowdown that's happening globally, the momentum in service sector exports is likely to be maintained. We may see some slowdown happening, some moderation, but overall, we remain optimistic on service sector exports for FY24.
All right. So, before we dive into services exports, I do want to ask you a little bit more about merchandise exports. Is the decline that we're talking about expected to be broad-based? Because, like you mentioned, on an annual basis, in recent months, we have seen a decline. And while you did mention what that's being led by, on an annual basis, most commodities seem to be lower than, like a year ago.
So some of the items like say electronic goods, they have been recording very good growth. Agri-product exports has also been okay. But if I look at many other components like say engineering goods, not a very good performance in the last few months. If I look at pharma, chemicals, very slow growth or even contraction. So I would say if I look at overall basket of merchandise exports, there is a slowdown happening, I would say all across except for items like say electronic goods and even agri, which continues to do, electronics is doing very well.
All right. So, during the pandemic, when a lot of high frequency indicators we were looking at were performing below par levels, exports was one of the indicators that continued to hold up, right? And now that we're talking about slower exports, I do want to understand what are the economic implications at large.
So, yes, you're right. Export was one item which had been supporting India's economic growth. So, when I talk about FY24, in fact, now it's the other way around. I would say we are most concerned about the developments in the external sector and impact of that on our exports. If I look at the domestic parameters, they are holding steady. Demand indicators, while we are seeing some signs of moderation and we are expecting some further moderation going forward as a lot of this pent up demand that we have been seeing wanes. But at the same time, I would say it's pretty decent in this volatile environment. But yes, I am concerned about exports performance. Like I said, merchandise exports, we're expecting a contraction of around 4 to 5%. So based on that, we are expecting GDP growth to moderate. But we are not very pessimistic on overall GDP growth. We are still expecting GDP growth of around 6.1% for FY24.
All right. So, like you did touch upon services exports as well. You do believe that services exports are broadly expected to hold up over the current year. Would this largely be attributable to increase in India's share in services globally?
Yes, that has also been happening. If I look at, firstly, services exports overall, if you look at services trade globally, that has not been impacted as adversely as global merchandise trade. So while global merchandise trade has been slowing down in the last few years, I would say services trade has kind of, not been hit that adversely by the whole slowdown that has been happening globally. And at the same time, India's share has also been increasing in the last few years. And specifically, if you see what has been happening to services exports post the pandemic, we have seen a significant jump that has happened, and that's something which we expect will result in, when we see the data on India's share in global services export, we would see a further increase. So I would say it's a combination of both the factors. One, the overall global services trade performing relatively better than what's happening to global merchandise trade, and more so India's share increasing in global services trade.
All right. So, I do want to clarify on one aspect. So, like you mentioned, services have so far held up broadly well, especially when compared to merchandise. But why is it that the trend is expected to continue? I mean, is it also possible that as the slowdown in advanced economies deepens, services exports too will come off some of their highs?
So, Pallavi, yes, we are expecting that there will be some moderation in services export. But if you look at what has been happening in the last few months, so while our merchandise exports has started slowing down in line with the slowdown that's happening globally, that's not the case with services exports. Services exports so far has held steady, which also speaks about some change that has happened post the pandemic in terms of demand for our services sector exports. If we look at the quantum, there has been a big jump in services exports that we were doing on a monthly basis pre-pandemic to post-pandemic. So this is a change which has happened, and I think this has got more to do with the global economic growth. It's a kind of a structural change that has happened. That's why I'm saying a lot of is going to continue, but yes, with overall slowdown happening, there will be some slowdown in services exports too. Like the last quarter number has shown some moderation. Services exports, the growth has slowed down to 3% or so from the very high 27-28% that we were seeing in the previous months. Having said that, still we expect services not to be very adversely impacted by the global slowdown.
All right. So, how does this outlook for merchandise as well as services trade tie in for your expectations from the current account balance in the ongoing year? Can we expect a slight improvement on the current account deficit front as well?
Yes, we are expecting an improvement on the current account deficit front. In fact, for FY23, if you remember 5-6 months back, most of the market participants were expecting around CAD to GDP ratio at around 3.5% or so. But now most of the participants have reduced their estimate, and so have we. And now we are expecting CAD to be around 2.1% of GDP in FY23. And even with the contraction that I'm talking about in exports in FY24, the merchandise exports contraction, even after taking that into account, we are expecting CAD as a percentage of GDP to reduce to around 1.6% or so in FY24. And that's mainly because while exports are going to contract, we are also expecting imports to slow down, which we are already seeing. Secondly, as I mentioned before, we feel that services export momentum will not be very adversely impacted. And thirdly, we have been seeing good remittances, and we expect that trend to continue. So, based on all these factors, on the CAD front, we are expecting a moderation. significant moderation to 1.6% of GDP.
All right, a couple of clarifications before I let you go. So firstly, on merchandise imports, merchandise imports too have held up over the last year. You did mention that they're now looking a little bit softer. Why is that? Is that because of lower commodity prices? And secondly, considering the broader outlook, how are financial flows expected to be over the next year, over the ongoing year?
So, coming to your first question first, if I look at the imports, what have been happening? So, if I look at whole of FY23, in the initial part of the year, crude oil prices were high, and that had an impact on our overall imports. But if I look at the trend for the last few months, the crude oil prices have gone down. So, to that extent, imports have been, moderating. But at the same time, if I look at even non-oil, non-gold imports, which gives an indication of what's happening to domestic demand, that has also been going down, which could be a reflection of, yeah, to some extent, even commodity prices will impact that. Even if I look at non-oil, non-gold imports, commodity prices would have an impact on that. But at the same time, this could be a reflection of some moderation in domestic demand happening too. And coming to your second question on capital inflows. So, capital inflows, let me talk first about FDI. So, FDI, we have been seeing some moderation happening in FY23. And I would say, again, that's broadly in line with, if the global economy is slowing down, we would see some impact of that on our FDI too. And if I talk about FY24, again, we expect just a slight moderation in FDI inflows in line with the slowdown happening. But we do not expect a sharp slowdown in FDI because Indian economy is doing relatively quite well compared to what's happening all around us. Hence, to that extent, we expect FDI to get decent inflows of FDI. Now, coming to FII inflows, well, that's the difficult part to project because that's very volatile. But broadly, if I try to infer in terms of what's happening around us, the expectation in the market is that Fed is going to stop hiking rates. Most probably, what we are expecting is one more rate hike in May, and after that, Fed is likely to stop. If not, then maybe one more hike. But the peak is quite close to us. And dollar index, if we see now, it has started responding to that. And we feel that, going forward in FY24, we would see some weakening of dollar index happening. So to that extent, in this environment, we could see some, increased inflows into emerging economies like India, which is doing relatively better. So hence, on the capital flows front, I would say we are not too concerned on that front. Ideally, going by what's happening around us, FII flows should improve going forward. But like I said, FII is the most tricky part to project. So we remain uncertain on that. But FDI definitely will not be much adversely impacted by the slowdown.
All right. So some relief on the external front and some challenges going ahead. Thank you so much, ma'am, for joining us today.
Thank you.
Stay tuned for continuing updates on the Indian economy.